The Relative Strength Index or RSI is a technical indicator used in the analysis of financial markets. It is intended to chart the current and historical strength or weakness of a stock or market based on the closing prices of a recent trading period. In this chart, the market value increased after the RSI climbs above the 30 level. The RSI is called oversold when it is below the 30 level, and overbought when it is above the 70 level. Traders expect market decline when the RSI floats in the overbought zone. As you see, the market reacted to the RSI oversold and overbought signal. Please note that professional traders don't use the RSI indicator as a trigger. The way Wilder recommends using the RSI indicator by using the 30 and 70 levels in the oscillator as oversold and overbought levels respectively. This means that when RSI falls below 30, you aim to buy the financial security that has been sold too much, and when the RSI reaches over 70, you aim to sell the financial asset that has been bought too much. However, these are not the only options. A way some successful day traders have found to increase the accuracy is by changing the definition of oversold and overbought to the 20 and 80 levels. Or indeed other levels. Of course, the price will get to these extremes less frequently than 30 and 70, thus in theory offering the most reliable trading signals. The main disadvantage to using 20 and 80 for RSI is that it means missing some potentially good trading opportunities. The solid ECN MetaTrader 5 trading platform conveniently allows you to set the overbought and oversold levels. Is a high RSI good or bad? Some trend-following trading strategies use a high RSI level as a sign to keep buying. However, in this instance the RSI is not being used as a trigger to enter a trade but as a guide on the direction of the trend. The first RSI in yellow uses the 70 and 30 setting with a 14-day period. The second chart uses the 80 and 20 setting for overbought and oversold on the same 14-day period timeframe setting. Both RSI configurations capture the initial buying opportunity. The 80 and 20 misses the first weak sell signal within the uptrend, then both trigger the next poor sell signal. Then both capture the third sell signal which precedes a nice downtrend. However, the 80 and 20 misses two more buying opportunities and one good opportunity to go short. Please note that professional traders don't use the RSI indicator as a trigger. The use of a divergence trading strategy is possible with multiple technical indicators, including MACD and stochastic. Divergence is when the direction of a technical indicator, usually an oscillator, diverges from the direction of the price. In essence, the indicator starts moving in the opposite direction to the price. The change in direction of the indicator is taken by forex traders or other traders to mean that price movements might be about to follow in the same direction. The oscillator in this scenario is a leading indicator for the price. In this chart the price continues to rise but the RSI indicator starts to fall from an overbought position. This is known as bearish divergence. After the price falls following the indicator signal, the indicator starts to point higher in what is called bullish divergence. Note, bearish divergences should normally happen at the end of an uptrend, while bullish divergences happen at the end of an uptrend. The divergence should ideally take place from an overbought or oversold level on the relative strength index. How do you use RSI strategy? Wilder advocated RSI indicator trading strategies complementing the use of oversold and overbought levels with the concept of divergence. The choice of indicator settings is best found through experience by each individual trader. Try different settings to see which work for your trading strategy or trading system. Here is one example of an RSI trading strategy to consider as a guideline for how to go about developing your own trading system. RSI, 2:90 and 1. This RSI trading strategy was developed by Larry Connors, and the idea is to find periods when the short-term trend is deeply oversold within an overall price uptrend or when the short-term trend is hugely overbought in an overall downtrend. Because it is intended for entry point within a trend, Connors uses a much more sensitive lower timeframe, 2 periods on the RSI. Because 2 is such a short timeframe, Connors attempts to filter out the false signals by using the 90 and 10 levels instead of the 70 and 30 levels for overbought and oversold. In essence, this is a trading method to buy the dip and sell the rip. Here are the steps to using this RSI strategy. Plot a 200 period simple moving average to determine the overall price trend. Add the RSI indicator and change the settings to 2 periods. Adjust the levels for overbought and oversold to 90 and 10. RSI Buy Signal. When price is bigger than the 200 SMA, and RSI period 2 is smaller than 10. Place a buy stop order above the last high. Rsi Sell Signal. When price is smaller than the 200 SMA, and RSI period 2 is bigger than 90. Place a sell stop order below the last low. Of course, in different trading environments the trading system will perform differently. For example, in a choppier trend or sideways price range, the 200 SMA will be less reliable as a trend indicator. Conclusion. Is RSI a good indicator? The RSI is one of the most popular indicators for forex traders, cryptocurrency traders, stock traders and futures traders. But it is not the indicator itself that makes users of the RSI successful in trading. Traders must spend the time to back-test an RSI trading strategy to make sure it has worked in the past and then test that strategy in a live trading environment with good trading discipline to have the best chance for a profitable trading strategy that works in the future. If you liked the video, please hit the like button and subscribe to the channel. Thank you for watching.